Hi, today I have our newest team member, Tim Boyd, joining me to talk a little bit about the market and PE ratios and how that informs investing. Tim is bringing a ton of experience to our team. We're really excited to have him. So Tim, first question, what is a PE ratio?
Well, first of all, thank you, Sarah, for introducing me on these videos, which I'm always nervous about, but that's okay. You ask a great question. So one of the things that I do, I just use the forward PE ratio as a guide to when markets are overbought, oversold. And the PE ratio is nothing, it's just simple in the fact that you have a price, how much does the earnings of the company make per year, and you find what that ratio is, okay? So I use the S&P 500, and what's telling about the chart is there were certain times in history, and this happens to be a 25-year chart going back to 1986, where anytime you start reaching north of 25 or just shy of 25, the market is truly in an overbought territory. So I take pause as I look at clients' portfolios and say, okay, we've had a great run. Is it time to raise cash? Is it time to reevaluate what the client has in their portfolio? So it's just one tool to use. If you really notice something about this chart though, 1987, which was a tremendous downward draft in the market, the PE ratio never really got north of 15. Okay, that's because the historical norm for the PE ratio of the S&P 500 going forward is about 15%, as you can say, 25-year average, 15.54%. Okay, and that's where things are fairly valued. Here, and from 2018 to 2020, you have a similar pattern, but we really never got much north of 24 on the PE ratio, forward PE ratio for the S&P 500. It gives me some pause, but again, is it time to raise cash? Is it time to take a look at things?
It gives you pause because it's so high?
Yeah, because things have been going for a long period of time. And notice you've gone from 2018 at a low, and election cycles factor into that as well. But you've gone from a low of 2018 at roughly 15, the average, and you went up to 23, 24. Okay, so this has been a massive move both ways and a lot of volatility. For the first time in a long time, we've had such great volatility. So now, when are buying opportunities for that cash, right? So maybe I've positioned some clients to 12, 13, 14% cash in their portfolios. And now you look and you say, okay, we're back to the norm. Is it time to start buying? Well, we don't know yet. And you can never time the market, right? So, but it's probably a good idea to start looking at ideas in stocks and or mutual funds to start investing again for your client that you happen to get out in cash. It doesn't always work, right? You might be too early. You might, on both ends, selling too early or
I was
buying
going
too
to
early.
ask, so is there a drawback to using this information?
Again, just a tool. The drawback is that you might be too early both ways.
Okay.
And since you can never really time the market, dollar cost averaging comes into it. What's going on in the interest rate world? What's the Fed doing? What's their fiscal policy? All goes into how we take a look at positioning clients in their portfolios.
And knowing that the Fed is most likely going to raise rates, what might that impact will that have on?
Well, raising rates, and you know what, I want to go back to a historical here a little bit. It has been a lot of years since we've had a rising rate environment. You got to go back to the 70s and early 80s when interest rates in the United States were actually somewhere between 10 and 21% is the high. Okay.
It's wild.
Crazy, but interest rates really affect multinational corporations' profits. Okay. So it's been a long time since the Fed has pulled away the punch bowl, which gives me a little pause. I'm a little nervous for clients' portfolios, my own included, only because there's nowhere to go here. And for the first time in a long time, the United States actually experienced negative interest rates below zero, real rates below zero, in this 2018 to 2022 period. And so now what we're feeling is the effects of interest rates going back up to normalization.
Which is not fun.
It's not fun, right? Because you had a major tech market that has benefited from lower interest rates to zero interest rates. But the consumer, on the other hand, if they're not in the market, they felt the effects of the 0.0% in their checking accounts as well.
Well, that's all we have time for today. But as always, please let us know if you have questions. And don't be shy. Feel free to reach out to Tim and say hello.